The Fed Chair Jerome Powell speaks again today as the Federal Reserve decides to raise up the federal funds rate again by another 75 basis points. How is that going to go ahead and affect the housing industry and the housing market right here in the Treasure Valley? Let's go ahead and get to all that information right after this. Well, welcome back after the break, everybody. Mike Petras here, your Star Realtor of Star and the Treasure Valley, back with another video to where we're going to go ahead and discuss and tackle Jerome Powell's speech today after the Fed had met and decided to go up another 75 basis points on the federal funds rate. So how is that going to affect the housing industry, and what should we kind of expect just here as a nation when it comes to inflation coming up? So let's go ahead, let's dive into that information. But before we do, as you know, I am a local realtor and a local certified master inspector right here in the Treasure Valley. And if you have any questions or you're looking to buy, sell, invest, relocate right here to the Treasure Valley, feel free to reach out to me via phone, email, text, or if you have any further questions regarding this, I'm very responsive in the comments below. Please leave a comment. Would love to hear your thoughts on what's going on, but also you can feel free to reach out to me, and I'll be more than happy to answer any questions that you continue to have regarding this video. So let's go ahead, let's dive in, see what he had to say.
My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools that we need and the resolve it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. The FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate. In addition, we're continuing the process of significantly reducing the size of our balance sheet.
Now, if there's anything that could scare buyers and sellers alike, it's them running off their balance sheet. Right now, the Fed has their hands on $8 to $9 trillion worth of treasuries and mortgage-backed securities. And if you do follow this channel, we do know that mortgage-backed securities, and of course the treasuries as well, is what really kind of dictates where mortgage rates are really going to end up landing. Now, why does the Fed have themselves control over $8 to $9 trillion worth of treasuries and mortgage-backed securities? It's because of all those low rates that we had over the last 10-year plus run. Basically, in order, what it was called was quantitative easing, and they came up and bought this all to basically kind of artificially inflate our economy in order to keep those rates down as low as they were for as long as they were. So what would happen if the Fed actually did decide to sell off their MBS and say some sort of a record number? We do know that you just introduce that MBS right back into the markets. And if we don't have investors to basically kind of pick up that slack more or less, then we do know that the price will drop. And we do know that if you do follow this channel, that when the price drops, interest rates can go up. And if interest rates go up to any kind of significant levels, then we can anticipate the buyer's demand to definitely drop off even further. And even for sellers, right now we are in that market correction. We can anticipate it to continue, and you'll just lose more value on your home as we go along. As of the September meeting, the Fed really said that they had no intention to start selling off their treasuries and mortgage-backed securities that they had bought during all those years of quantitative easing. But now it seems that the Fed is starting to change their tune. So we're just going to have to watch, and we're going to have to see how they react to all of this.
As I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal.
Now, here's where the wishy-washiness of Powell's speech starts coming into play.
That at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
But then he says this.
And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time.
At the time of the last September meeting. So what's it going to be, Powell?
reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. There's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing. And it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go.
So there you really have it out of the horse's mouth. Again, it's really dictating that the Fed is going to have to be aggressive and they're going to have to do it for longer. Core PCE and CPI reports, which really kind of dictate the health of our economy, are really kind of showing that inflation isn't being tackled on a month-to-month basis. So the Fed is going to still have to continue to get aggressive for longer. Do I anticipate them to actually start reducing the amount of increases that they're doing in the next meeting coming up in December? I do not, but we'll have to wait and see. So what do these increases in the federal funds rate really mean? It just means it's going to cost you more to be able to borrow money. Not necessarily as it applies to housing, but as it applies to credit cards or any other line of credit that you're really trying to take out. So what does this also mean? This also means it's going to be harder for businesses to operate. So what we can expect is unemployment to probably start ticking on the way up, which is what they want, a softening of the job market. But if we're taking a look at people like, say, builders, we've noticed, especially out here in the Treasure Valley, that a lot of the smaller builders have come to a complete stop altogether because it's just very, very expensive for them to be able to get the materials that they need if they have to get a loan to be able to do it. And even some of the major builders out here have started selling off their existing inventory and retreating back to pre-solds. Builders stopping building can also lower the supply gap between the demand. And then when the markets actually turn around and start picking up again, we could possibly, for sellers, anticipate that the supply and demand will actually lead to increased equity growth and maybe not the 3-4% stabilization in our market that the Fed is generally kind of looking for.
We need ongoing rate hikes to get to that level of sufficiently restrictive, though. We still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
So what does this also mean? This also means that the likelihood of the effects of a recession are going to be right around the corner. And for buyers and for sellers alike, that is a good thing because historically we know that when recessions hit and the effects of a recession hit, that rates historically come back down lower. So does the Fed really have what it takes to come in for a soft landing?
I'm wondering, has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to see the path. It's narrowed. I would say the path is narrowed over the course of the last year, really. No one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing, I would say.
Lies! You were totally confident that you're going to be able to come in for a soft landing, just like you thought that inflation was transitory. So in my honest opinion, do I see the effects of a recession right around the corner that will benefit both buyers and help out this market when the Fed is going to have to be forced to loosen their monetary policy? Yes, I see it coming, and hopefully I see it coming anywhere after the midterms to Q2, but we shall see. So just before we dive into what he had to really specifically say about housing and the questions that the reporters were asking him, let's go ahead and dive into this little tidbit.
The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. the thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect.
But you sure as heck know who did? Donald Trump.
Come on, man.
As we all know, anytime generally you mess with energy across the board, it's going to filter down to everything else. Hence why the Fed really doesn't look at food and energy costs and all that anymore. They kind of just take it out and kind of throw it to the side, to where, like, say back in the Carter era, it was really looked at. So that's why it's critical for American independent energy, so that we can go ahead and keep to work and be able to bring down these prices overall for the food and energy that we are spending. Right now, I don't know if you're in tune, but if you haven't read the article, looks like diesel is going to be in short supply, so buckle up, everyone.
Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. And we are seeing the effects on demand in the most interest rate sensitive sectors of the economy, such as housing.
You got that right. And as long as mortgage interest rates continue to be high, the buyer's pool is going to stay out, and we are going to continue in our market correction until there's some sort of cap or positive signs that inflation is reducing on a month-to-month level. But the flip side of that is also if the Fed is forced to have to go ahead and loosen its monetary policy because it over-tightened it too much with the federal funds rate where it's at. And what will that mean? That'll mean that it has ushered in the effects of the recession. And what have I mentioned before in this video? That when the effects of the recession are going to hit, we can expect them, the mortgage interest rates, to come back down. And that should be able to stimulate the economy, and people will get out there buying again, as long as there's not record unemployment.
With Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand. A lot of sectors you don't see a ton of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
If you look at housing, of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
And that's very true. Our market has actually been in a decline since really about late May, early June, when we hit the peak of the market. If you'd like to know more about what's going on in the markets right now in the Treasure Valley here in real estate, please check out the end of this video and click on my Mikey's Monthly Market Update video for October of 2022. Because the Boise area was actually the fastest growing equity gain in the entire United States, we are really also one of the first ones to start that market correction as compared to a lot of other markets across the United States. If I were a betting man, I would say that our area here in the Treasure Valley will probably return back to balance before any other general cities in the United States, but we shall see. But a balance may not return quickly if the Fed cannot show a month-over-month positive sign in inflation reduction, Fed over-tightening, which will result in the effects of the recession taking place, or the Fed makes a critical error and sells off way too much of their balance sheet. So we'll just have to continue to monitor the data and see from here and see how the Fed is going to go ahead and react at the next December meeting. So in summary, what did we learn about the Fed meeting today? And basically what we learned is that Powell and the Fed is still going to have to take an aggressive stance, which could be a good thing, and have to more or less force loosening the monetary policy and ushering in effects of a recession, which we know when that happens, rates historically come back down lower. So that could be a very good thing. But of course, if they do sell off their balance sheet a little bit too quickly in that aspect, they could potentially astronomically shoot interest rates through the roof, which would kind of continue this whole potential onslaught in terms of home prices across the United States. And just kind of really put it out of the reach of a lot of Americans to be able to afford. So that's always a possibility. I don't think the Fed is going to be that ridiculous about it, but they did say that they are going to start reducing their balance sheet again, which is something that they said that they weren't really going to do next or from the last meeting back in September. But we'll just have to see what happens in December and continue to monitor all this data. All right. Well, if you are looking to buy, sell, or invest in real estate right here in the Treasure Valley, please feel free to reach out to me. I can be reached at 208-715-STAR. Again, that's 208-715-7827. And of course, if you're looking to begin your home shopping experience today, please feel free to visit my website at www.yourstarrealtor.com. Also, if you're looking to relocate in from out of state right here to the Treasure Valley, please click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Also, please hit that subscribe button below, hit the notification bell so that you're constantly in tune with all the videos that I do come up with, and please don't hesitate to comment. Would definitely love to hear your opinion about where this is going and your thoughts. And of course, if you have any further questions, also comment below. More than happy to answer. So I look forward to that day that we speak. I look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.